over their over-the-top media providers such as Netflix and Hulu, who may not be able to provide the same one-on-one customer care. Third is there's an increased demand for media production all over the world, especially focusing in the UK or in Europe. Over-the-top media providers such as Netflix and Hulu have called for a demand for a higher fast broadband internet service that Liberty Global has been able to provide. As part of our analysis, we used Porter's five forces featuring rivalry among existing competitors, a threat of new entrants, and bargaining power of customers. This is to highlight that there is high competitiveness in Liberty Global's industry, but yet they are still able to be successful.
For our valuation, we use three models. First of all, we use the free cash flow model. This model is taken into account, starts with net income, hence taking into account debt and interest. Also accounts for changes in working capital, as you can see here, receivables, inventories, which don't play a role because Liberty doesn't have any inventories, and lastly here are payables. Next, it also takes into account capital expenditures. We estimate that Liberty will have 50% maintenance and 50% growth capital expenditures. Then we derive a free cash flow figure. A company can do three things with its cash flow. It can A, increase a dividend or start paying a dividend. It can B, pay down its debt, and C, it can also increase value to shareholders in the form of buybacks. So the cash return is derived by taking the free cash flow we arrived here and dividing that by the net enterprise value, so taking the equity market cap, so the share price multiplied with the shares outstanding, minus the cash on the balance sheet as the buyer gets to keep that. So we divide the free cash flow by the net enterprise value and derive a 5.36 and 14.73%. That is our hurdle rate, and it's very good for Liberty as this number is increasing to a double-digit number now. Next, our second model is an EBITDA model. It is preferred on Wall Street, and that's why also we used it. Next, so we start with net income. It's the same estimated net income figure as before. Liberty has never issued any preferred dividends, and we estimated that to stay the same. So net income equals earnings. Interest by us is estimated to increase. This is due to the highly debt load Liberty has taken on. Tax is decreasing from 303 to 234 due to the tax reform. And then taking also into account depreciation and amortization, we end up at our estimate of EBITDA for 17 and 18. And lastly, we've taken a lifetime value model because Liberty operates on a subscription-based business. So for this, we have some inputs such as monthly revenue. We've taken that number to be 55 due to some bundling packages being valued at a much lower price than that, and some at a much higher price, say 63. So the margin here is 70%. We estimate that Liberty keeps 70% of its revenue here as profit. Then we've got the retention rates 95%. So we estimate that after a month, still 95% of customers of Liberty will retain the company. And here to the right, you can see the retention chart. So that will say that after a whole year, 12 months, close to 60% will stay with the company. And the large driver of this is the decreasing churn in Europe. Taking into account the free cash flow model, the EBITDA, and the lifetime value model at different weights, because we think that the free cash flow model has significant advantages over the other two models, we arrive at a weighted price target of 39.57. And while you may think that is not significant upside, we only have a 6% upside. When we first did this analysis, we had an upside of 18%, meaning that the market is realizing our undervaluation of Liberty and is already picking up on that. So it just reinforces our buy recommendation. We have also done some financial analysis. Earnings have been negative from 2007 to 2015. In the past 2 years, they have been positive, and they were likely negative due to a rising interest expense. On the cash flow statement, Liberty has excellent quality of earnings, meaning that net income is operating cash flow is always in excess of net income, and operating cash flow was always in excess of capital expenditures too. Also, Liberty has a negative cash conversion cycle. That means that Liberty gets paid before it has to pay. The balance sheet here reflects the debt load. In particular, in 2016, Liberty had a debt to equity ratio of over 300%. For financial ratios, let's look at the liquidity ratio. Our current assets divided by current liabilities ratio was increasing from 0.37 to 7.3, meaning that yes, it is on the below one, but we have high hopes, and we're very confident that soon this ratio will be above 1. Next, we've got also the solvency ratio, and here we look at the interest coverage ratio, meaning that we look at how much EBIT is available in a company to cover its interest payments, and that was 103 and 117, meaning that Liberty has enough EBIT to cover its interest. And yes, the negative cash conversion cycle also was also been mentioned. Next, we have a DuPont analysis, and we can see that leverage here with 5.59% is the largest driver of return on equity. And the next two slides we will skip due to a financial constraint, and my colleague will continue with the risk analysis.
So part of our analysis, we created a risk matrix to show 9 of Liberty Global's most impending risks. This was based on impact and probability. There are 2 risks I'd like to focus on. The first is changes in technology that may limit the competitiveness of Liberty Global. As mentioned before, Liberty Global is focusing on competitors such as Netflix and Hulu as some of their main competitors, and their second risk is future acquisitions may not be successful for Liberty Global. This is important because Liberty Global focuses on future acquisitions. As mentioned before, they've had a lot of success with acquisitions such as Vodafone. We see that favorable market conditions, favorable market conditions, Liberty Global will be able to mitigate these risks.
And just a quick recap, we recommend a buy for Liberty Global. Our 1-year blended target price is $39.57. That's an upside of 6.82% from $36.87. We use 3 different valuation models: free cash flow, EBITDA, and lifetime value. And we identified 2 major catalysts to be operations outside of the US and Europe and Latin America. In the chart, you can see that they can make gains on the weakening US dollar, and also that they are market leader or second in many of the markets in which they operate. Thank you, and we're now open for questions.
Question number 1. What was the closing price yesterday of the stock?
From my recollection, it was $36.52.
think is paramount. And also we've done the EBITDA and the subscription-based model. So we didn't think it was necessary to take the. So, but if you would like a return on equity, I can give you that number in the DuPont analysis.
No, I'm interested in understanding the difference between the return on cost of capital and the return on capital. If the return on capital is higher than the cost of capital, then that should be the management's goal. Is that the management's goal? What is the management's financial goal?
I think it is first and foremost to reduce debt and soon to pay dividend to increase shareholder value.
Okay.
So you guys didn't do discounted cash flow?
No, because we first of all Liberty couldn't pay dividend, so we couldn't do the corporate dividend.
One other question for me is, I think you mentioned on one of the slides that when you were looking at CapEx, you said 50% of it was what you call maintenance, so 50% of it is growth.
Yeah.
How did you come up with that estimate of 50?
Just because we looked at the 10K and it only said that it's having a rising capital expenditure figure, and then we estimated to say that 50% of capital is used for maintenance requirements of buildings and driving. Because we thought that once the fiber cables are laid, there isn't much maintenance to be doing on those. So you could put the extra 50% in back into the business and having new capital requirements or expansions in other countries.
Do any of you pay for cable TV service, broadband or video?
Virgin Media.
All right.
Last question. Are you concerned about John Malone's cholesterol level? My question is, how much are you concerned about John Malone, being around for a long time?
I think since they have Mike Fry's right below him, that they're not too worried about that as of now. And also they have a whole succession planning committee, so I don't think that will be too bad. Although he is a very key, important person, I don't think that they're too worried.
There is no succession plan in place.
Not that we found publicly, although we see with Mike Fry's and with the success of John Malone's other companies that there should be a succession in place, and I'm sure Mike Fry's has been groomed in case of an incident to happen.
Isn't that one of the risks with the company? Something happens to him, what happens?
I think that could be a risk with any company is when your CEO, if something were to happen to him, there's always people underneath that would be able to take the succession plans underneath, especially operating since they do have operations in Europe, South America, and as well as the United States. They have their headquarters here, that they would be able to find a succession plan.
So currently, who's that number 2 man? So currently, who is behind him as the number 2 person who might be able to take it over?
Mike Fry, the CEO.
Okay.
Nice job.
Yeah, thanks.
That my request.
It's probably
Christy, what's my-
Take your time. I'm sorry? Marshall is keeping time over there, and he should be, there's Marshall, so he's waiting.
I know.
But then Marshall, when we hit the 10 minutes, say, if you could announce time out loud, please.
Okay, they came in under last time.
Right, but
Got it.
one of the judges asked, how do they know when the time's up?
No, it's a Q&A time.
Right, Q&A time.
Oh, I might having the Q&A as well. Communication breakdown,
10 minutes, yes.
10 minutes, got it.
At 1 minute, give them full of the 1 minute.
I was just fascinated by the company, so I was willing to listen forever, but I will be.
So do we need to present using this PDF? Simultaneously in the PDF. That's already open.
Oh, I'm sorry.
I'm just, is this?
We may have sent this and then when we get our technical person.
I will see that.
Okay, well, we can get.
It's just not.
I said it both just in case. But
Yeah, we have them both. I mean, worst case scenario, I know how to work a space bar.
If that's not working, I've got the other one on my computer.
No, this is fine. We'll, it's just we can't use a clicker with this guy, but.
Okay, well, we can get the one off the other computer and send it to this one. And so we've got, it's a PDF, it's not the PowerPoint.
If you'd like this, like I said, this will.
Are you okay with this? Okay.
We can press up, down, I
Okay.
got all the keys.
All right, very good. Okay. So University of Northern Colorado, and just to be clear, Marshall or timekeeper will waive something saying we've got 1 minute, and when time's up, he'll say time, and he'll do the same thing. Q&A is also 10 minutes, and he'll also announce time at the very end, and he'll waive his 1 minute thing until one of the team members sees it, okay?
All right, well, hi, we're here from the University of Northern Colorado, and we're here to present our by recommendation on Liberty Global. We'll start with the business foundation, go over future potential growth, profitability, and investment risks. We have a $45 price limit on Liberty Global, which offers a 23% upside since January 12, 2018. Liberty Global was founded in 2005 as a result of a merger between Liberty Media International and United Global Com. This created the largest broadband company in the world, and Liberty Global continues to grow. It operates in 12 countries through 4 subsidiary companies and 1 joint venture with them. Its strong subscriber package is what attracts customers and keeps a hold of them. Historically, Liberty Global has grown through strategic mergers and acquisitions, including that of Unity Media in 2009 and the Virgin Media acquisition in 2013. The company places a high amount of importance on infrastructure investments, and since 2013, 14.5 billion euros in total capital expenditure has been spent on infrastructure, customer and business support, and premise additions throughout Europe. With the guidance of John Malone, the majority shareholder and owner, Liberty Global's revenues have increased significantly. They offer quad play services to most of the countries, and this is very attractive and has helped bolster revenues. Liberty Global has embarked on many ambitious projects throughout the past few years in order to help differentiate itself from its peers. It has laid fiber cables into the grounds of most of its areas of operation, and major projects like Project Lightning in the UK help to increase revenues and deliver the fastest internet to customers there. We've seen a massive shift in the customers' preferences in regards to broadband versus cable. And people are switching to more of a broadband heavy preference as they want internet content streamed straight to their computer. Because of this, we believe that that broadband will be their most profitable business segment because of its high margins and just the ability of Liberty Global to control the delivery of the content to its customers because of its past material infrastructure investments.
So by 2020, 39% of content will be streamed using a broadband service. This is something that is concerning to traditional video providers due to the fact that not only will they lose subscribers, but also revenues because of this change in consumer preference. Liberty Global has positioned themselves well enough in the market through their subscriber packages to incentivize their current subscribers of video to hold on to that and receive cash benefits by subscribing in mobile and broadband services as well. It is because of this operational position that they're going to continue to be profitable. And although video in and of itself will not grow in profits, it will not see the losses that others in the market will. So as far as revenue goes, one of the biggest drivers here is subscribers. The 2 areas where consumer growth will be highest are the UK and Germany based off of our forecasts. Year-over-year growth will be highest in the United Kingdom due to Project Lightning. And if it continues to be as successful as management predicts, the United Kingdom will be the largest center of revenues moving forward over the next 5 years based off of our forecasts. Broadband strength as well as this consumer growth will also lead to a 5% aggregate revenue growth over the next 5 years. Our forecasts predicted around a 6% increase in operating cash flows over the next 5 years. This paired with management's guidance on the 5 times EBITDA leverage target tells us that we will see more utilization of long-term debt by Liberty Global moving forward. While this does mean that interest expense will be a larger part of the financials, and there will be more exposure to interest rate risk, Liberty Global will remain serviceably liquid moving forward. As far as net income goes, based off of our projections, we saw Liberty Global moving from a net operating loss in 2015 to a net operating profit moving forward. Now, this has large implications on tax strategy due to the fact that Liberty Global utilizes net operating loss deductions to minimize their tax expenses. So in various taxing jurisdictions that are very important to Liberty Global, the current NOLs on the books will be expiring within the next 5 years, primarily in the United States. And because they are moving to a net operating profit as opposed to an NOL, they will be unable to accrue more NOLs moving forward. So this is something to keep into consideration when looking at tax strategy. As far as ROE is concerned, our projections showed that it will increase greatly over the next 5 years. This is in large part due to the increased net profit margin, as well as increased operational efficiencies throughout the entire business. This paired with a highly leveraged balance sheet shows this increase in ROE moving forward.
So we use 2 different methods to value Liberty Global, our discounted cash flow absolute valuation, and the enterprise to EBITDA relative valuation. Forecasted revenues will be as a result of increased broadband penetration as well as customer growth stemming from disposable income growth. Now for our absolute valuation, we used a terminal growth rate of near 1.5% based on our forecasts, as well as forecasts provided to us by the World Bank and IMF on European GDP growth. We arrived at a terminal free cash flow around $5.6 billion and used this to derive a final share value of $46. For our EBITDA multiple, we used a multiple of 8.9 based on our analysis of the information and communications industry, which included Liberty Global, their competitors in Europe, and similar companies within the United States. Using this valuation, we came to a target price of $43, and after weighting both equally, we arrived at our final target price of $45. We used a weighted average cost of capital of 7.8% to discount our cash flows using both our forward projections for debt and the capital asset pricing model. Because Liberty Global will be moving towards a net operating profit, we used a tax rate of 15% because we felt this more closely mirrored the actual financial situation that Liberty Global will be in the future. We used the risk-free rate of 2.5% based on the 10-year treasury and risk premium of 7.5% based on the 10-year return of the S&P 500. To derive Liberty Global's beta, we ran multiple regressions against the S&P 500, finally settling on the 10-year or 7-year quarterly performance of Liberty Global as the best estimate of Liberty Global's true beta. There are three factors which could affect our recommendation. A possible merger with Vodafone could add anywhere from $9 to $13 per share based on the structure we saw with the Vodafone joint venture. Higher than expected growth in the UK and Ireland could also add additional value to shares. We see revenue of 8% adding $7 to our target price. We can also envision a scenario where higher competition and higher costs could reduce our recommendation. If we saw aggregated revenues growing near 4% with operating expenses 75 basis points growth under that, we would have a final target price of $38, which would reduce our recommendation to a hold.
Better understand the third of the risks that Liberty Global faces, we plotted them on a matrix based on likelihood and impact. We've highlighted 3 of these key points as most likely cause for concern for investors, and I'll now go into those in detail. John Malone holds a substantial amount of voting power and ownership in the Liberty Global. Currently, 75% of the approval from the voting shares are needed in order to pass certain transactions. John Malone, owning 25.4% of these voting shares, could hold the potential to hold the company at a stall if he chooses to do so. However, we do not see this as a likely cause for concern. John Malone's high stake also means that he is in line with a long-term strategy, just like the large institutional investors that are like Berkshire Hathaway and Dodge & Cox that are in line with them. Back to that. Sorry. And then John Malone, not to mention, I'll just go. Okay, so Brexit, popularly known as Brexit, British government has just enacted Article 50, the withdrawal from the European Union. So this causes uncertainty. We've already seen increased volatility from the British pound from the Brexit decision. We could also see increases in tax regulations, laws and law reform, and differences in trade policies with the European Union. Liquidity risk is also a major concern with any highly levered firms such as Liberty Global. However, Liberty Global has done a very successful job in mitigating that risk using derivatives in the past involved with interest rate risk. So to recap, the key drivers moving forward for Liberty Global stem from their strength in acquiring customer growth, their ability to increase price per unit based on cross-selling of broadband and TV, and their ability to expand rapidly should they need to do so. So we'd like to reiterate our buy recommendation of $45 with a price target of $45 and a 23% upside. And so we'd like to open up the floor to questions now.
Okay, you mentioned the weighted average cost of capital of 7.8%. What is the expected return on capital?
We don't actually have an answer for that at this time.
Do you know what the current return on capital number is? Return on capital.
We don't have an answer for that question.
Did you guys have a slide with return equity?
Huh?
Did you guys have a slide with return equity going forward?
Yep. So I can tell you, return on equity right now is right around 5%. We project that moving forward to about 25%.
I'm not talking about just equity, I'm talking about total capital employed in the company. That includes debt.
We do not have an answer for that at this time.
Let me ask you a very abstract question. What is the difference between Liberty Global and a similar cable operator in the United States? What's business-wise? What's the difference in business-wise between them and Comcast, just broadly?
Well, I think right off the bat, just the cultural differences in the different countries of operation. Yes, they are all in Europe. However, each market has a different requirement of Liberty Global for themselves. So whereas the United States, where Comcast operates, is a generalized market where there are some consumer preference differences, it is not necessarily a cultural preference difference. So the ability to use mergers and acquisitions in order to get a foothold into different cultural segments definitely gives Liberty Global the opportunity to succeed based off of those cultural differences.
I think that to better answer your question, Liberty Global is different in Europe than Comcast because of the viewing habits and the consumption habits that we see with European customers and consumers. We notice free-to-air TV within the United Kingdom, within Germany, and those places. So there's a lot more competition from free services that we see within those environments than Comcast readily deals with here in America. Because of that, Liberty Global has had to use a lot of cross-selling and the actual subscriber packages to attract some of their video subscribers. And they've also had to have more premium products. We see the 4K V6 Virgin set-top box in the UK right now as kind of an example of how far forward they have to go to attract those video customers.
Perfect. I guess one question on the FX, because you mentioned that I think Brexit and the effect on the pound is your number one risk for us. As an equity holder, since you're recommending a buy, is it better to have a strong dollar compared to all of the euro, Swiss franc, pound currencies, or a weaker dollar?
Do you want me to answer?
Well, we'd like to see a weaker dollar, just in terms of transaction costs. We can see more flowing into the UK, and then we can see more, with a weaker dollar, we can see more flowing into the US.
And do any of you actually subscribe to cable television services, broadband or pay TV?
No.
I am a benefiter of. Right, not subscribed.
Gotcha.
Are you guys concerned about their debt levels?
Not particularly, no. We've seen Liberty Global hedge a lot of their risk from interest rate exposure and everything like that. There's over $19 billion of their current long-term debt is covered through interest rate derivatives, and we see $17 billion under shorter-term basis swaps with the actual interest rates. Liberty Global has done actually really well at remaining serviceably liquid. We just saw this last year, them holding over $1 billion in free cash. So they are a company that's able to service the debt that they're issuing.
What percent of their cost is fixed versus variable?
So we do see more variable costs. I can't give you an exact number. Most of their fixed costs right now, we see their indirect costs, which we do see forecasted going pretty level or even going down within the future. Those costs are customer care and networking leases and things like that. We have seen a pretty steady rate within their variable costs we project their forward cost of goods sold percentage, their gross margin percentage remaining relatively stable within the future. So most of this operating cash flow growth we see coming from that stability.
I'm talking about the cost of borrowing.
Oh.
The cost of borrowing fixed or floating.
So we have seen the majority of their debt right now is under fixed interest rate. Within their actual debt model, when they do issue these variable rate loans, most of what they do is switch out these interest rates for a fixed rate using basis swaps and things like that. So we do see a majority of their debt right now covered as a fixed interest rate.
That's right, 99%. Is what the 10K says. So, you were talking about, how you came up with your WACC calculation, and you mentioned, you derived a beta of 1.5, doing some sort of correlation. Were you surprised to see us as a higher, beta than the overall market? And why do you think we're at, 1.5 as opposed to being closer to 1, the S&P?
I guess we weren't too surprised after just a little bit of thought. We do see higher performance with Liberty Global and maybe some more volatility. There's also, what we have to remember is Liberty Global initially was Liberty Global and Lilac. They were tracker shares. So we saw maybe some of that performance modeled a little. Definitely weren't that surprised.
Nice job. That also creates a team. Finds faster speeds when it's denser. Here it's less. What's that? So it's
How's it going? What's the timing going, Rachel? Peachy. Peachy? You haven't convinced me. What is that little thing? Is that a Chromebook? It's an iPad and a thing. That's cool. It'd be even cooler if I could make it work. It was working before, but it's not working. Yeah, nice to see you. Hey. Good to see you. I'm well. This is a little, let's just do this. We're doing mic or no mic?
That's.
Where's,
I think we'll be good on this.
Yeah.
Let's wait.
yeah, hold on just a second.
Okay.
So I'll be doing,
Yeah.
I'll be doing the timing over here. I'll hold this up in 1 minute.
Oh, okay.
Thank you. And then answer questions over the I'll stay there.
That was the one that was given me.
It's zipped. That's why.
Give me one.
You can control
Yeah, it's not opening. It just
Oh,
says that the file is
okay.
zipped.
All right, Ashley's working on it. If not, I've got it unzipped on my computer and we can resend it from my computer to here.
Okay.
Let's see if I can get it open. Excuse me. You were D?
Yes.
Download it. We'll have to grab his computer just in case.
What did you do?
Just have him grab his computer. Oh, there we go.
Okay.
Yeah, I'm sure.
Is this the clicker or?
I don't think it works with PDF.
Okay. I'm just gonna test something. Okay.
My name is Connor. I'm joined by Aaron, Quan, and Will, and we're the University of Denver team. We're here today to talk to you about our buy recommendation for Liberty Global. We found a target price of $42 with an upside of 15%. As I'm sure you know by now, this company is very complex, so let's get right in. Liberty Global offers broadband, mobile, video, and fixed line telephone in over 10 countries across Europe, with 54% of their revenue deriving from the UK, Ireland, and Belgium. Market line industry reports have all the industries growing at 2% over the next 5 years. So we have signed a 6% CAGR for Liberty Global because they've actually outperformed the market by 8.5%. And breaking down their operating expenses, depreciation and amortization makes up 35% of their operating expenses. And this is due to the capital intensive nature of setting up infrastructure. And this is further explained why they're heavily leveraged capital structure, which is actually par for the course across the industry.
As Connor mentioned, Liberty Global operates in a very capital-intensive industry, but they also operate within 4 different industries. So let's break them down. In 2016, cable and broadband made up the majority of Liberty Global's revenue, and both industries are forecasted to grow at low single-digit rates into the next 5 years. This is mainly due to increased smart TV penetration and community Wi-Fi. MVNO and fixed line markets are expected to grow a little bit differently, with 1.4% expected CAGR for mobile and 0.5% expected CAGR for fixed line. This is mainly due to the expectation of 2020 of 5G technology expansion and also the modest growth in bundling popularity. Some key trends and drivers that affect all 4 industries are bundling, increased consolidation, demand for subscription TV, and a new tech-savvy consumer. As of 2015, 54% of consumers preferred to bundle versus not, and as of 2016, this is up to 68%. Also, there's an increasing demand for high speed, and we believe that 1 gigabyte will provide more opportunities for increased internet usage. Also, the cost of data has been decreasing over the last decade, and we expect that to continue into the future.
This is mainly due to price compression across all 4 industries. We conducted a Porter's 5 forces analysis on Liberty Global as a whole and within their specific industries. Overall, we found that they operate in a very moderate competitive environment with a lower threat of substitution. We believe Liberty Global is a strong buy due to their competitive positioning, proven strategy, improving financials, and competent management team.
Let's jump into that the competitive positioning. There's a demand for higher quality and lower prices, while the interest in providers' reputation is becoming less important to consumers. As you can see, Liberty Global is very well positioned through Virgin Media and Telenet and the high quality, lower price. Although UPC and Udemy Media are a little bit pricey, they have room in the resources to improve this positioning. Through MVOs, the data focus as well as bundled services, we believe they have a strong competitive position. Capitalize on MVNOs. Liberty Global is positioned through a majority of the subsidiaries through MVNOs, which are mobile virtual network operators. 2 big benefits of this are they allow them to compete on price without having to, with just leasing the infrastructure rather than owning it, which also helps them increase their distribution channels. There's a data focus. So right now there is a roaming while at home in Europe, and this is regulation that's predicted to decrease the profitability of margins of operators in the region, in the industry. And we see Liberty Global being less impacted by this due to their shot size, as well as the regions they're operating in and their current structure. This produces opportunity for them to capitalize on M&A activity of operators that are kind of squeezed more heavily on their margins. Additionally, excess roaming usage, which is kind of a variable that's unpredicted right now, could create data offloading potential for them to opportunity to capture more broadband opportunities. So, additionally, they use bundling to create a stickier customer. They do this with their by combining packages through double, triple, and now quad play. Also, there's an extreme amount of potential in their B2B. An example of this would be in Belgium, where they're using their small office, home office revenues, which experience a lot of growth, and their use of the WIGO. Additionally, we also issued a buy recommendation based on their proven strategy. We believe Liberty Global is well positioned in their strategy through fueling their organic growth by building infrastructure. Right now, they have Project Lightning, which is contributing $8 billion to the UK economy, and also providing broadband customers with faster speeds. As mobile broadband convergence continue to rise in Europe, this presents an opportunity for them to capitalize on through the building of infrastructure on this organic growth. Additionally, although Project Lightning has some issues in 2017, we see more forecasts from our analysts for positive results in 2018. They're improving their inorganic growth, which is another piece of their strategy, through M&A activity. They've had a vast history of M&A, and this presents more opportunity in the future. As the market becomes more consolidated and competitive, there's more emphasis on regulation and development, as well as opportunity for MVNOs to offer cost-effective ways to enter new markets. Lastly, they're committed to returning equity value to their shareholders through buyback programs. And last year, they authorized a $2 billion buyback for 2018.
Along with that, we believe that Liberty Global is a strong buy due to their improving financial margins. As you can see, for the last 3 years, the company's EBITDA, EBIT, and net income margins have been increasing or remaining steady. And this is mainly due to mobile revenues increasing and broadband and B2B remaining steady. As you can see, over the last 12 months, Liberty Global captured the best EBITDA margin out of its competitors at 42.7%. Regionally, the UK and Ireland has been experiencing some compressing margins. However, in Germany and Belgium, Liberty Global has increased their net income margin and recaptured some market share. Liberty Global has a great ability of generating a lot of cash flow from their operations, which is a really great sign for the company. They also claim the top cash flow to sales margin in 2016 out of all their competitors. We expect them to maintain lower levels of cash in the future as they invest in additional CapEx to fuel 5G technology. Liberty Global has been paying down long-term debt for the last few years, and we believe that they'll increase their debt very steadily over the next 5 years due to that investment in CapEx to fuel 5G technology growth.
Liberty Global Competent Management Team, additional stock compensation, and John Malone leadership contribute to a buy recommendation. Michael Fries, the CEO of Liberty Global, has extensive experience within the industry and is heavily invested in the company. We believe that he will use his connection to the professional community to capture growth opportunity. Fries and his management team received additional stock compensation last year, giving us confidence that they will continue aligning the interests with the company into the future. Finally, John Malone, father of US Cable, chairman of the board, leadership has John Malone leadership has he's owning 3% of the company, as well as having his majority holding within the industry. Malone is dedicated to the company and the industry. We believe that he's an excellent investor due to his holding being the S&P last year. And finally, we believe that John Malone and Michael Fries will propel the company into the future. Let's talk about valuation. We consider competitive positioning, strategy, financial, and management team. Here we use EV to EBITDA and free cash flow to equity model to evaluate. We use EV to EBITDA because of the company's unique debt structure, and FCFE because the company generates a lot of cash. We weight them at 30 and 70 to get a price of 42.36. To get our cost of equity, we use the CAPM model, and our long-term growth rate, we use the US inflation rate. We assume the revenue will grow at a 6% CAGR with depreciation growing. We believe this is mainly driven by mobile and broadband growth, as well as the investment into 5G technology. Our FCFE price here will be at 44.51. For a relative model, we compare the company with 5 competitors and average the EV to EBITDA to get value of 8.5. However, because of the company's superior operating margin, we put a 10% premium on the multiple to get 9.4, so around a price of 37.34.
Moving on to risk, we created a matrix in order to weight probability versus impact in order to rank it. In operating over 10 European countries, they're heavily exposed to currency risk, as well as a strong US dollar adversely affecting their share buyback strategy. But management has shown their capability in recent years to hedge that with increased derivative activity. And then moving on to market risk, with the availability of content over the internet, it stands to decrease cable subscription revenue, but this also can be hedged by exclusive sports packages and content. And then increased EU protections recently with pushing down of roaming charges to protect consumers against bill shock could adversely affect mobile revenues. Well, we created a sensitivity analysis to weight increased cost of debt and cost of equity versus terminal growth in order to show the robustness of our buy recommendation, as well as a best case scenario being $44 and a worst case scenario being $39. Risk is included. We just want to strongly reiterate our buy recommendation for Liberty Global with a target price of $42 and an upside of 15%. Thank you.
Okay. Question on the capital structure. Given the heavy debt burden the company has and the expected rise in rates, you said you increase the cost of debt going forward, right?
Mm-hmm.
Okay. So what is the current weighted average cost of capital and the current return on capital, total capital, versus the expected weighted average cost of capital and the expected return on capital?
Okay, I think Quan might be the best to answer this situation.
So with the current cost of capital would be around 5.6%.
5.6?
Yep, and our current return on invested capital is roughly around 5.4. So
5.4?
Yes, so we're pretty much breaking even at this point.
That's the current?
Yes.
And how about the expected?
Expected?
Now, you mentioned that you didn't include that as a part of your...
With our sensitivity analysis?
How it affects our...
But did you translate that into developing the expected weighted average cost of capital and the expected return on capital?
I'll be honest, we did not. But we mainly used the expected or future possible increases in cost of debt and cost of equity to see how much our buy recommendation would be affected. And as you can see from this graph, I mean, cost of debt has to increase by 2% for us to actually get to a hold recommendation. So we really used it more as a tool to assess how good our validation was with our buy.
Well, how does the company hedge the risk of rising rates? Do they hedge the risk of rising rates?
Through derivative activities increased over the last 3 years. If you want to jump to that risk slide. Pulling from their 10K, they operate using currency derivatives as well as interest rate derivatives to hedge against that risk since they're such a heavily leveraged position.
To add into that, they already have a plan for the next 5 years on the derivative spending. to hedge those risks as well.
And we obviously took those derivatives into account and tried to assess if they didn't have that hedging in place, how much that would affect their net income if they experienced like a 1% increase in average currency rates. It would be more of a depreciation where the euro and the pound got weaker. And we found that it would be about, was it 12%?
24%.
Okay, twice that, 24% decrease in net income. And that's if there's no hedging in place. However, with their extensive hedging history and also how much they've gained off derivatives, we highly doubt they're not going to be hedging any of that risk. So
They won't be hedging what risk, currency risk or
Both.
interest rate risk?
both.
They won't be hedging.
We expect they will be. We doubt they won't be. That's what I meant. Sorry.
Got it.
So, can I ask a very video question? If you compare Liberty Global to an American counterpart, you can pick your choice, Comcast, whatever. What's the difference in business model or market differences?
Okay, I'll jump on this one. So overall, we believe that the U.S. Cable media, broadband, internet, mobile, fixed line, they're very more mature than the European market is right now. This is mainly due to there's only like maybe 3 main competitors. Over in Europe, a lot of MVNOs kind of are all over the place. That's the mobile only. And there's so much more room for consolidation than here in the U.S. So we see that being a potential for Liberty Global to M&A and capture on those MVNOs, not MNOs, I'm sorry, in the future, because it is a cost-effective way to enter the market. And I don't think Comcast and I guess Charter, they don't really have that opportunity because the market is already so consolidated.
Yeah, and just to add on to that, I guess the segmentation of the EU with being operating in different countries, and how Liberty Global offers different brands within different countries to kind of cater to each market. Whereas I think in the US, it's more of a broad consumer base where everybody has similar tastes. I think that the industry as a whole is transitioning to more towards the US where there's education on that customer base and consolidation.
What is the company's credit rating?
It's double B minus.
Double B minus? Stable?
Due to the forecast on CapIQ, they are focused to be stable in the future.
But how about the rating agencies? Are they saying stable or negative? Okay. Very down.
We apologize, we have not looked into that. We only look at CapIQ as our debt forecast for now.
Yeah, with S&P.
I'm sorry, I missed that. The S&P saying what?
Yeah, as far as S&P that we referenced, they said stable.
Oh, okay.
Yeah.
You had a big list of the M&A transactions the company's kind of undertaken over the last 5 or 6 years.
Yeah.
What do you think is the next M&A transaction that's going to happen with this company? Or what would you recommend? I mean, being that you said it's kind of a core part of the thesis, where do you see it going from here?
Can I take this?
Yeah.
So we see a lot of M&A activity coming in more of the mobile section as they're building more organic growth from building infrastructure to kind of grab more of the broadband, provide faster and more quality data. We're looking at more opportunities in mobile due to the stress of this roaming at home, as well as like these small MVNO operators that are in small niche segments that compete on prices. But when the roaming takes over their customers' travel, they're facing silent roaming charges. They might be facing customers that travel more frequent and not being able to kind of like stay alive or selling that business off completely. We'll provide an opportunity for them to grab steals and maybe potentially capture some of those services and those customers from them for like a discount, depending on as compressing margins go forward. So we see it more in the mobile.
I love the fact that you're all wearing the same ties. Just point that out. If you could go to your valuation slide, why did you decide to weight the EV to EBITDA and the free cash flow the way you did, the 30-70?
I'll take this one. So a lot of analysts have used EV to EBITDA, but also this adjusted EBITDA that Liberty Global, has in their 10Ks. We wanted to use just the regular EBITDA because this is where a lot of companies come in where we can't compare them to Liberty Global on their adjusted EBITDA kind of number. We also looked at other multiples like EV to subscriber, just trying to capture as much of the company as we could, but we thought EV to EBITDA was the best. The reason we weighted it lower was because Liberty Global operates in the US, like they bring it all back into US dollars and are under GAAP, versus these other companies in the EU that are under IFRS, and it's much more lucrative, it's more flexible. So we felt like they were on different playing fields, and also like Comcast was included as just a comparison rather than a direct competitor. So we still liked our model for EV to EBITDA, but we thought it was a lower weighted model. We believe that we can forecast their cash flows more to the actual company and their growth prospects by using the free cash flow to equity model. So that's why we decided to weight that model heavier.
First question, what happens tomorrow? The stock is at $42.37. Just, your target price is $42.36.
Yes.
Tomorrow is $42.37. Is that a sound?
If we go back to the sensitivity analysis, kind of have an increased granularity, but most of all showing just different sensitivities to the cost of debt versus equity, and in those cases where it would be a buy, a hold, or sell, based on a rate of.
I just want to ask, can you like clarify that question? Just
So
one
my
more time?
point is this: so today your your target price is $42.36. Tomorrow the price, not your recommendation, but the price moves to a penny higher than what your price is today. Would you say it's a sell, or at what price would you want to sell the stock? So the question is like.
That's a good question.
So I think I might be able to answer this. So in our model, we put a rate of roughly 8% as our cutoff rate. If the price fall below that, it's a sell. So if our price here, or 1 cent over is not enough for a sell for our target price, so we have to have rough enough 8% over our target price to have.
We have to rerun our model too.
Yes.
So
yeah, has to have the 8% over.
Maybe the last question, we're getting the 1 minute warning here. Is an equity holder, I know you've talked a lot about the FX risks that we run. Is it better or worse to have a strong US dollar compared to all of our European exposure?
much worse. Adversely affects your share buyback programs. Obviously, if those currencies are higher, when you transfer them back, more US dollars on your books.
So they're going to translate to more transaction loss in their foreign currency loss on your income statement, meaning to lower net income and everything else.
Thank you.
Nice job.
No, I think. Oh, yeah, exactly. Yeah.
What's that?
Actually, you. Yeah. Oh,
I took my school, they were like, shut all my clothes in my school. And they're like,
Sure. Oh, really? Yeah. Oh, great. Oh, thank you. I met you before, so I don't know where. You look familiar.
Maybe we've met at another event with the BOE. This is.
I don't know, I feel familiar. I didn't know you were. I'm sorry? I didn't know you were based. Oh, yeah. So you guys traveled all the way from Bolton to go.
Yeah.
How do you like this?
You need to go, yeah.
Honestly, it's like I have a 6-channel son. Is there parties for, you know, like everything is how you want it.
Yes. You can make it parts for sure. But you can definitely get into top firms and anything more investment or consulting, and you can work more. But if you want to sit around and do nothing,
It's very accommodating.
Yeah. It's big distribution.
A lot of.
They do push you.
Okay, it's on. It's not on that target.
We go to see bus games. Yeah. That's just.
Do you have a chance to know Roberta? It's probably on the nets. Roberta Kasha?
Hey, Dan Friedrich.
Nice
to meet you.
Sorry?
You wrote it. Has it changed at all?
Why?
I did this one.
Just, I mean, that was.
Yeah.
It's very different. It's very different. Well, no, it's good piece this way.
All right.
We're just waiting for one judge in the back.
Oh, perfectly fine, no worries. Just
Let you guys stew a little bit longer.
stew in our own sweat.
We'll do that. See how it works. Just always just.
Hey, Peter.
I'll make sure to do it over here and not at our time keeper.
I would if we had. Yeah, we can check it. Is the microphone?
How you doing? Good to see you. Hey, nice to see you. Hi, how you been?
I've been doing well. You having a good time?
Yeah, it's fun. Have you talked to Bob or at all?
It's been a while. To be
Yeah,
honest.
I haven't talked to him.
I should probably, I'm hoping I can give him some crap in 2 weeks if the Patriots lose.
Oh, okay, yeah, that's fine.
I'm just sitting back watching you guys do all the hard work.
On the timer. So if it doesn't seem like any of you are seeing that, I will probably jump on. Otherwise, I'll just.
Sounds great.
Thank
you.
Okay,
So Marshall will, when it's 1 minute left, he will wave that so that he's there. And it's the end of the 10 minutes, he will stand up and he'll say time. Okay? Okay.
Here we go.
Are we ready on? Oh, wait a second, I'm sorry.
We're
You
gonna
gotta
go
wait
more.
till, I thought we had all of our judges here. Gotta wait till. And there he is. Right. You guys all set? Okay.
Good afternoon, everyone. Thank you very much for joining us. I'm Roberto Limas.
I'm Dan Friedrich. I'm Jeff Harrison. I'm Rich Nacho.
We're now presenting on Liberty Global. Now, it's important to note that Liberty Global should not be thought of as one company, but as a holding company with 5 different subsidiaries. Each subsidiary operates on mobile, broadband, fixed line telephony, video, as well as business services. Now, going to the financial data, you can see a bit of a head and shoulders pattern starting in around May over here. And we're starting to see maybe another head emerge since December 27, 2017. And that is due to Liberty Global's successful divestiture of their Austrian assets. Now, after careful analysis, we believe that this company is worth a buy with an upside of 12%. This is due to 3 factors: strong quarterly RGU growth, particularly in their third quarter earnings. Second is their strong consolidation through further divestitures. And 3 is their potential Central and European growth. Now, going into our business subscription, you can see that the 5 subsidiaries operate in specific geographic regions, with the exception of Austria right here, which was just divested to Deutsche Telekom. Each subsidiary is fully controlled on or partly controlled on by Liberty Global, with the exception of VodafoneZiggo, which is in the Netherlands. That is currently a joint venture with Vodafone right now. Now, moving into the industry positioning with the Porter's 5 forces, we believe that this sector is a very intense sector due to 3 factors. The first is, of course, high barriers of entry, low economies of scale, and a strong regulatory framework. Now, as for consumers, they do have some buyer power over Liberty Global, mainly in their video and fixed line telephony, because they're able to access online content such as Sling TV and Hulu as well. However, Liberty Global does have some control, as that you need to have broadband and mobile to access those services online. So Liberty Global does have some control. Now, going on to a competitive overview, we see that Liberty Global has a 35% market share. We do expect them to maintain their market share as the first largest in Europe right now. And that is mainly to the fact that we do expect to see strong RGU growth continue on up to 2021, as well as seeing a strong price increase once per year in order to maintain steady revenues, if not higher. But of course, going to the European Union, we do see that after many years of stagnant wages and income, we do start to see a strong growth, economic growth happening, especially happening more in Eastern Europe than in Western Europe. And while we do have some concern as to the rising substitutes, we do think that Liberty Global will be able to control that through their quad play development. I'm going to pass it on to Daniel Friedrich, who will talk about our financial analysis.
All right, so top line revenue compounded annual growth rates are supported by our thesis. In 2015, revenue grew by 0.11%, 2016, 1.3%. If we add in Vodafone Ziggo, we're looking to see about 5% in expectation for 2017, and in 2018, with our RGUs that we project, we're looking at about 8% growth for the company. UPC, you can see declines, and that's because we attributed the divestiture of Austria in 2018. RGUs historically have declined, and that was due to mainly unsubstantiated price increases or multiple price increases that occurred in these timeframes. However, we feel Liberty has adequately addressed that, and now they are pushing only a 1 price increase per year. We feel that, along with seeing the third quarter RGU growth occur in Western Europe and Virgin Media, where they have that Project Lightning that's building out, to continue to develop RGUs, along with Central and Eastern Europe being a blue ocean. From that standpoint, that RGU growth with a one-time price increase, we feel will create the ARPU growth you see in the chart that's either flat going through 2021 or either growing by a small percentage. While video and fixed line are at 32% of revenues, down from 47% due to substitution, we believe, the quad play product or some sort of bundling product will bring that back up to around 35% throughout the rest of our projections. The chart on the right shows that Central and Eastern Europe are a blue ocean for Liberty Global. We feel that because of mobile and broadband penetration rates are smaller than what is going on in Western Europe. And while they've seen that growth in Western Europe through Project Lightning, we believe they've also seen growth in Central and Eastern Europe right now. They hit the 100,000 mobile subscriber mark with UPC in mobile, and we believe that can continue. Along with that, for them, the divestiture that was opportunistic of Austria, which garnered an 11x return, can provide additional CapEx, which can continue to fuel that growth into Central and Eastern Europe. While gross margins and operating margins decline in our projection going into 2019, that's mostly due to the fact that premium content consolidation is occurring and price increases are coming through that, which is hitting their margins and cost of goods sold, along with, as we modeled, a network build out occurring and labor cost increase going up in Europe, which is hitting the operating margin. However, that catches up after 2019, and we're seeing 35% in the margin for gross and operating around 15% on average. Along with that, our EBITDA to interest expense stays relatively stable at around 3 times, and the long-term debt to equity we kept within the 4 to 5 times range for our projections into 2021. Now I'll pass it on to Jeff, who will continue on with our valuation.
Thanks, Ted. So we used 2 main methodologies to value Liberty Global. The first one was a sum of the parts methodology, where we took each of the major operating subsidiaries and ran either a discounted cash flow or a discounted cash flow to equity on them. These results can be seen in the chart on the right, with the base case highlighted in yellow. We also ran scenario analysis on these to draw a range of values. The second methodology we used was a traditional aggregate DCF, the results which can be seen in the chart below. These are the equity portions of the free cash flows to equity. The sum of the parts valuation yielded a share price of $39 per share, while the aggregate DCF yielded a share price of $42.25. And we believe that the sum of the parts methodology is justified because when we priced it on an EV to EBITDA basis, it fell within the range of most comparable companies. Our final target price of 41.92 was derived by weighting the DCF at 60% and the sum of the parts at 40%. Now I'm going to pass it off to Amaresh, who's going to talk about risks.
Thank you, Jeff.
So we see the main risk for Liberty Global are from the currency risk, because majority of their operations are in Europe and the exchange rate plays a significant role. However, we feel because of the Fed tightening coming out here in the US, historically it's seen that it weakens the dollar for almost a period of 2 years after the tightening occurs. And the low interest rates in the UK and the European market will mitigate any interest risk they have in the future. As we see, Liberty Global has been expanding due to by borrowing considerably, but the management has highlighted that they would bring down the debt target to about 4.5x in the future. And due to the low cost of borrowing in Europe, this risk is pretty much low for Liberty Global. Coming to regulatory risk, the ECC is looking to open up markets for more competition, and this being a capital-intensive field and Liberty Global being the market leader in Europe, will be having an opportunity to capitalize this group in a blue ocean in the Central and Eastern European markets. However, the UPC and Ziggo merger is a moderate risk in the future, as EU is looking to review the deal due to monopoly concerns. On the whole, since Liberty Global has significant RGU growth and is having about 4 billion revenue generation in the next every quarter, we feel it's a buy with a 12-month target price of $42 and an upside potential of about 12%. Thank you. Any questions?
Let's say Europe tomorrow goes into very severe recession. Are you concerned about this problem? Consider they have a lot of debt.
The debt rates are pretty low, and due to which Liberty Global is right now having a lot of tax concessions as well here in the US. Even though it goes into a recession, mobile connection is like a tobacco for current generation and going into the future. So we feel it will have a lower effect than what we anticipate. That's what we.
Along with that, they haven't extended all of their debt so far, so they have some borrowings left over still. I think it's around 500 million is left over in debt borrowings that they could exhaust.
What percent of their debt is in US dollars versus non-US dollars?
I think the majority of it is in US dollars. Can't give you exact percentage. I don't remember that exact percentage.
That's all right. That's all right. And have you looked at the company's weighted average cost of capital?
Yes, actually, in the UPC fixed income filing, they had provided a weighted average cost of capital, which was around 8.5%. We feel that our overall weighted average cost of capital that we created is kind of reflects within that range.
It's about 8.5%. What is the return on capital?
It's pretty low. It's around 1.5%.
Say that again.
1.5%, I think.
1.5?
Yeah.
The cost of capital is 8.5?
Mm-hmm.
Wow, huge gap.
Yeah.
Is it a good strategy for the company to borrow at 8.5 and earn 1.5?
Well, they're borrowing at substantially lower than 8.5. Their cost of equity is around 15%. So that's driving up the cost of capital.
The UK just lowered their rates, I think, because of which they had hedges being beneficial for them for last year.
Early on in the presentation, you mentioned that one of the issues that we've had is with price increases, and perhaps taking too much. I think you referenced the double price increase that we did. What do you think is an absorbable price increase that the average customer can take in our markets? If you were advising our consumer team, what percentage price increase would you recommend?
We would expect to see, I'm not too sure about what specific number we can be able to give you right now, but one thing we're trying to see in the European economy is that many of the consumers, they're starting to save less and starting to consume more. And that's what's been indicated currently with some previous consumer surveys in Europe. I would say given the fact that their incomes are going to be increasing as well, we're not sure about the percentage, but we can say around a 5 to 10% increase of current prices. especially given the fact that Europe right now, currently, Eastern European incomes are right now lower than Western Europe, but it's going to be growing faster. That makes sense.
If you're creating that bundled product, I would say then you can increase in the 5 to 10% range where you're giving more value to the customer. However, the one-on-one price increase is going to have to be a smaller margin.
Why did you decide to weight the DCF 60% and the sum of the parts 40%?
So the DCF took an aggregate portion. So we basically forecasted every single sum of the part. So we did DCFs for all those companies. So then we took an aggregate and created an entire aggregate out of that with a conversion ratio for all of it into US dollars. And so that's why we then weighted it a little bit more.
If you had to compare Liberty Global business market in general versus a company like Comcast, again, I'm not asking you to compare stocks, just business-wise. What's the difference between a company operating in Europe that's based versus American?
Well, there's significant differences in demographics even between European countries and American consumers. So they're pretty different companies and different products and services between them overall, especially in terms of enhanced versus basic video.
Yeah, so you have a different type of subscriber in Central and Eastern Europe. That's more of I would say a mobile type subscriber, in that sort of way. So you have DTH out there, which is the dish satellite that they use along with some mobile. And then they're getting more broadband fixed line in Western Europe. With those, so it's two different types of strategies in that way, I would say, versus the Comcast out here, in general, is just one person looking for a bundle who wants a low price product, right? And that's the competition.
Let me rephrase my question. I was concerned about Netflix displacing, subscriber in the US versus in Europe. Which should I be concerned about, the US subscriber or European subscriber?
I would be more concerned about US.
Why?
Currently, one thing we found with European subscribers is that while we do have some substitutions, there are some original content Liberty Global provides, such as sports coverage, which, let's be honest, that's one of the main reasons why people buy video in the first place. And while Hulu and Sling TV are trying to get into that market, we do not see them being able to successfully enter it for the next few years. And so that's where we think the European subscriber will be more beholden into Liberty Global than the American subscriber will be to Comcast, using your example.
Why? I mean, I'm just trying to get the answer. I'm not getting it. Why can they import into Europe versus the United States?
Because I feel there's a lot more diversity in languages and they wouldn't prefer Netflix over to local programming channels, which you can see even in India and any other emerging markets for these substitutes. They are struggling right now in India to expand, especially Netflix and Amazon Prime. And we feel the cable and broadband plays an important role for the layman in Western Europe or Eastern Europe, I'm sorry.
I think you mentioned EV to EBITDA multiples, but I never really saw what multiple you're placing on our business. So I guess my question to you all is, what do you think is a fair EV to EBITDA multiple for Liberty today?
Yeah, you don't want to see the slide again?
Oh, sure.
Yeah. So around 10 times earnings, 10 times EBITDA. Yeah.
So you perfect. Go back. So your target price is $41.92.
Yeah.
Tomorrow we wake up and the price, Liberty stock price is trading at $43.
Mm-hmm.
Do you sell the stock, or what do you do? When does it become a sell? When do you say?
Well, that would depend on your investment philosophy.
Okay.
So right now we feel they're on an upward curve. I think maybe they would peak at around 50.
The 52 is your upper target?
Yes. I mean, I would suggest if I was to be.
I mean, if they're hitting 43 tomorrow,
then they would hit about 52.
Then obviously there's some efficiency that the market's seeing, right?
came up with a target price of 41.92. Do you have a horizon date on that target, like 6 months or 1 year?
1 year. It's a
It's a
12
12-month target price.
But under his assumption, if the price drops, it shoots up to 40 through tomorrow, would you be recommending getting out of the stock? If your target is 42, and target horizon date is 1 year, well, it's got to be 2 to 3 days.
Well, if you get a 12% return a day, it's a good idea to probably get out of it. But the upper range of our some of the parts valuation was around $46, so we believe like up to that could be justified.
What do you see as the bigger risk, regulatory or currency?
Regulatory risk, and that's mostly due to the fact that the EU might try to make it into a commodity, commoditize the market in general, and make everybody, it must be given to everyone, broadband, in that sort of range.
Currency is a risk that you can hedge right now. And Liberty Global still managed to do a pretty good job at that right now. But regulatory, there's various factors that frankly you cannot control.
And to an equity holder, for you owning Liberty Global, is it better to have a stronger dollar compared to all of the currencies baskets that you've discussed, or a weaker dollar?
The weaker dollar would be better, and that's because of the price conversion, right? So again, as we spoke to in 1994 and in 2006, you saw Fed tightening had actually structurally and technically weakened the dollar going in, and so we feel that's counterintuitive. Yeah, it is counterintuitive, but it is something that we've seen before, and that's happening right now. So we feel that for the next year might devalue the currency a little and keep it within that range of trading on the higher end between sterling and euro.
Nice job.
Thank you.
Yeah.
Just give it a textbook financial metrics. Yeah, a lot of the acquisitions
Is it? I'm more pointing towards theater. When they say it's like somebody who can work for us.
That was like,
Just an old ones. Pardon? Put a pin in my salad. But I've got some new ones coming.
I just always.
Which I thought their whole thing was online. It's like, isn't that cost your business model?
A little bit. You have to resist the urge. I've been doing hand signals. Yeah, when they're like, how much of your debt is in US dollars? 0. Effectively. Well, we can't enter equity value, right? So that's the issue, is we have a dollar denominated stock price, but we generate our cash flow in other currencies. The debt side, it is. So the debt side is completely fixed.
Well, that's good for you.
So what we may raise US dollars debt are immediately swapped into euros or pounds.
Trifocals that time she's too.
And that's been about every single presentation. There is no rate resistance. We've turned all the people fixed, which has been the wrong move, at least over the last 5 to 10 years. But you know, as a management team, we're not being paid to forecast interest rates, so. He has been saying
it's like template charts. They don't work.
So you can easily
can't use them, so we'll say like certainly click on your state.
I'm Marshall, I'll be your time. Okay, so, the comments obviously, we may have minutes, another 20 left. I will leave this. And, when we're done, I'll speak.
Yeah.
If you want to have some more specific
Not the next one. Ashley? Here we go. And guys, we've got another. I don't actually don't know which one you try it. Got another microphone here if you want to use it.
Okay. Yeah. Trying to figure out how to get that.
And your judges are here. Keep that in mind. I don't know. Where you stand. Is the clicker working right?
Yeah, is it all right if I just use the?
Whatever you want, sure. You guys all ready?
Ready.
Okay, go ahead.
Right, good afternoon, everybody. We're the team representing the Metropolitan State University of Denver, and we're here to present to you our analysis of Liberty Global. We've issued a buy recommendation for Liberty with an end-of-year price target of $48.57, which represents a significant upside from yesterday's closing price around $37 a share. We've identified a couple key areas of Liberty's business that allows them to gives them their competitive advantage. One of these areas is their tax-efficient capital structure that they will make use of, a strong history of free cash flow, as well as a strong leadership team with decades experience in telecommunications and financial services industries. John Malone sits at the chair of the board, and he's a well-recognized industry veteran with decades experience in telecommunications industry. And before serving on the chair of Liberty Global, he served 24 years with TCI Telecommunications Inc., building that into one of the largest telecommunications providers in the United States. His expertise, along with CEO Mike Freeze, who also has decades experience and leadership experience in telecommunications industry, along with Charlie Bracken, who has extensive background in financial services and advising on telecommunications companies. We feel that this competent management team and diverse management team gives Liberty a competitive edge and allows them to stay successful and impactful on into the future.
Liberty Global operates in 12 different European countries and through 5 subsidiaries. These include Virgin Media, which makes up about 40% of total company revenue, UPC, Unity Media, Telenet, and also the joint venture, Vodafone Ziggo. Their services include video, internet, fixed line, and mobile phone. The company's approach focuses mainly on strategic acquisitions, as well as growth through networking expansion. European GDP growth is forecasted in the 2% range in 2018. We do believe that Liberty's stock price is reflected in that expectation. However, we do also believe that the lack of regulation in the European telecommunications industry and the increasing popularity of the internet usage in the daily lives of European consumers play a larger role in Liberty's ability to generate cash flow. One of the biggest threats in cable TV revenue is the growing demand in streaming services, including Netflix, Hulu, and Amazon. However, we do believe that the sports and premium packages, along with bundling services, these help Liberty retain, and attract new customers.
Next, I'm going to talk about Liberty's competitive position. Liberty Global is diversified geographically, and it offers a variety of products. And I stumbled. One second. Its subsidiaries are one of the top performing companies in the regions they operated. The bundling services that Liberty Global offers puts them in competitive advantage. It allows their customers to have a convenient service as well as reduce their power of buying. Bundling and premium programming also reduces the threat of streaming services such as Netflix or Hulu because it offers more products at a more convenient fashion. Liberty Global has been expanding in the last few years its network extensions. In Q3 of 2017, they added 310,000 homes to their homes passed network, which is reflected in Virgin Media's 36% penetration rate in the broadband industry, and compared to 82% of UK's broadband industry overall, leaving a huge room for growth for the penetration rate. The Liberty's product is also considered to be superior. Our contacts from Eastern Europe and UK informed us that the bundle services are convenient and that the internet that Liberty Global offers is fastest in those regions. To wrap up the section, Liberty Global is a diversified company that has huge room to improve or increase its penetration rates, and it offers convenient service or product that is superior quality, utility, and it blocks the ability of new entrants and subsidies.
So we believe that expectations about the impact of Liberty's investment in network expansion through Project Lightning in the UK largely drives the company's stock price. So with a 3.1% increase in average revenue per user, 4.2% increase in internet subscribers, and a 2.6% increase in video subscribers over the last 12 months, Virgin is beginning to penetrate their expanded footprint and slowly increase pricing. Given Virgin's network capacity and 63% triple play penetration rate, we're really excited about that business unit's growth potential. While Liberty has significantly more leverage than most other European telecommunications companies, we're not concerned about Liberty's liquidity position or ability to service their debt. It's important to note that Liberty's reported earnings are unimpressive by design. And so depreciation expense that is the result of prior acquisitions allows the company to pay very little tax, while an operating cash flow margin of 31.6% gives the company plenty of cash to continue to expand their networks and return cash to shareholders through share repurchases. In addition, Liberty shares are trading at a price to free cash flow multiple that's well below most of their peers. And so this may be a potential relative value opportunity for investors there. We value Liberty using a 70-30 mix of a two-stage free cash flow to equity discount cash flow model and price to free cash flow multiple analysis. Based on historical trends in our forecasts, we used a 3% annual revenue growth rate for the first 4 years, and then a 1% growth rate from there out. We used a 12.5% CapEx to sales ratio, which is in line with peers as well as Liberty's average rate. Our cost of equity of 12.12% is based on Liberty's 52-week adjusted beta, as well as a 2.45% risk-free rate and 6.81% equity risk premium. While our target price for the year is $48.57, that's a 31% premium to the current market price, or current market price as of Friday, I think was that date. We think that the strong cash flows and tremendous growth potential really give Liberty, give our valuation justification.
All right, real quick, I'm going to try to discuss any of the risks that we saw. So we looked over Liberty and we saw 3 potential risks, that being government regulation, interest rates, and then finally technology. So for government regulations, we saw that they're not only regulated in the countries in which they operate, but they could be also regulated by the European Union as well. So mergers and acquisitions, such as in wireless services, mergers and acquisitions being a key pillar of their business strategy, could either be delayed or denied by European regulators. In addition, interest rate risks, so they carry a lot of leverage on their books. The leverage, especially when the debt comes due, for instance, they have $32 billion of capital lease expenditures and debt coming due by 2022, could really cause Liberty problems if interest rates increase in the future.
Okay, that's fine.
Questions?
One slide back.
Yeah. Sorry if I'm standing right in front of it. Let me know.
One more.
Oh, one more?
One more. Yes, one more. It was a slide because I'm sorry, we didn't miss it. Go back. It was a slide, yeah.
Oh, okay.
Well, it was a slide which I think was very interesting. Oh, yeah, no, that was it.
Okay.
The cost?
So no, SG&A percent of sales. I thought what was interesting that their SG&A is 18% versus TalkTalk 36%, whatever, much higher.
Yes.
Well, why is it so low and why Proximus is so, is a bit lower?
So we see a couple things there. First of all, that number is an aggregate number for Liberty Global as a whole, whereas like the numbers you're seeing that are huge, like Sky, TalkTalk, and BT is high as well. Like those three top, well, Deutsche Telekom's in a similar position, but the 3 British companies have really high SG&A because there's a lot of competition there right now. And so Liberty's SG&A there is proportionally higher compared to UPC's or one of the other smaller subsidiaries. So part of that is that it's aggregated. We also believe that part of that is that that's the benefit of Liberty's size, so they can spread those SG&A expenses across the firm and manage churn that way whereas like TalkTalk's a tiny company, so relatively.
What percent of their expected revenue growth is coming from organic growth versus what percent is expected to come from M&A?
Our forecast is totally based on organic growth. We didn't really attempt to forecast M&A because they've done so much of it that like, I mean, the Austria business like announcement came out a month ago, but we didn't really want to price that in, so.
I noticed in one of your estimates, you had a beta of 1.4, which means we're more volatile than the market.
Yeah.
Why do you think we have greater volatility than the average company in S&P or whatever your benchmark is?
Well, so thank you for asking that, because beta was a hard thing for us to really use, and that we tried to do that with the scenarios, because if you look at like a 2-year beta, it's closer to like 1.25 or so, so it's lower. We think that betas, because it's European, all your operations are in Europe, even though we don't think like operationally, like there's really much issue with the currency, still US investors are gonna price it that way, especially with the political climate, so.
From a risk standpoint, what do you think is the biggest? Is it regulatory, is it interest rates, or is it technology?
Anyone?
I would say regulatory would be our biggest identified risk. We see Liberty as being a relatively favorable negotiating position through their subsidiaries and through the markets that they operate. But there's still a lot of uncertainty around the political climate in Europe. Whereas opposed to, say, the technological risk, we feel Liberty is much more positioned to take advantage of, as instead of being a risk. For instance, the move to 5G that's coming, we believe Liberty is able to take advantage of that, and we don't necessarily see that as a risk for the business.
Kind of a broad question for you guys. If you compare Liberty Global, a company that operates in Europe, versus a counterpart in the United States, what I'm asking you just about the business, let's say Comcast business and cable business versus Liberty Global. How's the US business is different from Europe?
Well, thank you for that question. Does anybody want to take this one?
I'd say like European.
I would say that the US business is more developed than the European business. And the European business has actually, for that reason, more room for growth.
I think to second that, and this is what I was hoping that you would say actually, is like, it was difficult for us to wrap our heads. We have some sense of what consumers here are doing. It was difficult for us to wrap our heads around why someone in Czech Republic would choose UPC over their other options. And so I think what we came to was maybe sports programming could be very region specific there. Whereas in the States, it's like if you have the NFL, that's a lot of the programming that people are like really, really paying for ad space on. So
I also noticed that you guys paid less for content in Europe than we do in the United States, which makes your margins better.
Yeah.
Speaking of content, what was your forecast for inflation on the content programming cost? Do you think it's going to grow higher than some of our other costs, lower?
I would say, generally speaking, I would guess higher, only because since Virgin's so much of the business and there's a lot of competition, you guys are paying for programming from your competitors, they can pinch you.
How many of you subscribe to Netflix?
I steal Netflix from my parents.
Yeah.
So are you guys concerned about John Malone's health?
We definitely saw it as a potential risk and some need for some type of succession plan for what happens when he becomes of age, that either no longer wants to be at the head of the chair or head of the board, or is incapable of being head of the board. We didn't see it as any particular or as a significant risk just because of the team that he has built around him. We see as being very competent and very experienced in the industry. Mike Freeze has been there since the inception, so we see him as If anybody needed to step in and line up succession, that we have confidence in his ability to kind of take over the helm and run the business successfully.
He's also a son-in-law, so he's
Yeah,
probably
and
told him a couple things.
Different one. He married a different one. Yeah.
As far as like an estate planning concern as well, he has 4.5 million shares of the Class B, which we saw had like 10 votes per share. So he has veto power basically over a lot of the decisions. So maybe investors could be a little bit concerned or could cause some contention there.
I think, sorry, that's actually a really big issue. I didn't think about that, but with TCI, right, there was a big mess with Bob Magnus. Like when he died, shares got shuffled around with his sons and like, I think it was his wife, like it caused a lot of problems, potential problems. So I guess that is a concern, right? The voting shares that Malone holds, where those end up matters.
Which I think he's probably learned from the plan.
Mike has a right of first refusal on those.
So awesome.
So I just target price target was $48.
So
here's my favorite question. If the price tomorrow, the price is at $49, would you sell the stock?
No,
I
I
don't
wouldn't.
think that we would sell the stock. I think that we'll keep it, just because we have a lot of confidence in the company, with our forecast, and also John Malone knows what he's doing. So we just feel like there's just a lot of room for improvement after the upside.
$80?
I'm sorry?
Now you're talking.
I think
That makes him
so.
smile a little bit.
We really hesitated to incorporate this into our valuation because we don't feel that we know enough about like potential future M&A, potential future investment and network expansion. I mean, Unity Media is growing really nicely, but we don't know like exactly what's going to happen in the future. But once like, so the growth CapEx is going to drop off a cliff when they own these assets, right? And then it's going to be just a cash cow. And so I would hold the stock for sure. Like if it was $49 tomorrow, I would just camp out.
You're now at 49?
No, I'll hold. I'll hold.
All right. Now, one of you mentioned that they're not really worried about the company's leverage and liquidity. What gives you that confidence?
So my confidence from a liquidity perspective, Charlie Bracken, his experience level as a CFO, I just don't see like that kind of short-term pinch that way. Like the company's matched its debts well with its functional currencies. Like I don't think that liquidity issue as a short-term issue is a concern. The leverage issue for sure could be a concern with dramatic regulation change, right? Like if there was a big price regulation on the rates you guys could charge, obviously like that could really impact the debt level. But as far as right now, we don't see that. And there was no indication to us that was like really a substantial risk.
Thank you guys. Thank you. Thanks.
Thank you.
Well, thank you very much.
Thank you very much. Thank you. Thanks. Thanks. Good job. Great time.
Yeah, I'm not sure what they No, I still send it
How am I doing? You're really good. Thank you. My colleagues. I've been known to watch the clock many days. All right, I'm gonna be your cameraman, Marshall Douglas. I'm sitting over there.
You're very important.
Thank you.
Don't undersell yourself.
I'm one person. I believe so.
Just don't shout.
For timing purposes, we have 10 minutes. When we get to 9 minutes, we have 1 minute. I'll wait this. When we're at 10 minutes, I will stand up and say time. And then we'll start the timing for the questions. Questions about something. All right.
Thank you, Marshall. There's one guy.
I'm John. This is Rick.
Another week and a half.
It's always a question. People bring it up. I doubt it. All the Liberty companies.
Yeah. I think it's
Denver's got cable. The legacy of this.
Just been here since still people do, don't worry. But yeah, the good stuff. You don't come up with
Is it a part of the same nature? I got you.
You guys all got your added up from, already? Okay. Go ahead, this is Colorado State, our last team today.
Good afternoon, and thank you for joining us. We're from Colorado State University, and we'll be presenting our analysis on Liberty Global. We initiate coverage with a buy recommendation on Liberty Global Class A stock LBTYA with a one-year target price of $41.84, representing a 13.4% upside from their closing price on January 12th. Liberty Global was formed in 2005 through the merger of United Global and Liberty Media International. Since then, they have grown both organically and through various acquisitions to their current size. In 2015, they spun off their Latin America and Caribbean segment into a separate tracking stock, shown in gray, and then that business was successfully spun off at the end of 2017 into its own business. The majority of Liberty's revenue comes from their fixed line assets, providing video, broadband, and fixed line telephony to their customers. Key metrics for these segments are RGUs, or revenue generating units, essentially the number of customers per segment, and ARPU, or average revenue per unit. Liberty recently expanded into the mobile segment, shown in yellow, primarily as an MVNO, meaning that they rent other companies' mobile networks. And lastly, they have a B2B segment, which offers all the previously mentioned services, along with web hosting, security, and other business-specific services. Liberty is composed of 5 key subsidiaries: Virgin Media, Unity Media, UPC, Telenet, and VodafoneZiggo. Due to their 50% holding of VodafoneZiggo, it is not included in their consolidated revenue. Virgin Media is Liberty's largest subsidiary, operating out of the UK and Ireland, and is currently undertaking a long-term growth strategy called Project Lightning, which seeks to connect 4 million new homes to their network between 2015 and 2019. Unity Media operates out of Germany and has the strongest organic RGU growth out of all of Liberty's subsidiaries. We believe this helps to make up for their limited mobile and B2B segment. UPC operates out of Switzerland, Austria, and various countries in Central and Eastern Europe. Due to the underdevelopment of the telecom industry in Central and Eastern Europe, it provides a great growth opportunity for them, which helps to make up for the slow growth occurring in Switzerland and Austria. At the end of 2017, they decided to sell off their Austria segment to Deutsche Telekom for 1.9 billion euros, or $2.3 billion, at a 10 times EBITDA multiple. We expect this deal to go through at the end of 2018. Telenet is a 57.6% equity-owned subsidiary operating out of Belgium. After their 2016 acquisition of Base, they have the best product diversity out of all of Liberty's subsidiaries. This allows them to offer fully converged products to their customers. Wigo is their fully converged product offering, giving customers video, broadband, fixed, and mobile telephony under one simple, easy package. VodafoneZiggo is a 50-50 joint venture between Liberty Global and Vodafone, formed in 2016, operating in the Netherlands. We believe the combination of Liberty's fixed line assets and Vodafone's mobile network, along with the support and expertise of both the parent companies, will help this joint venture to grow into the future as they recognize synergies and are able to offer fully converged products. I'd now like to hand it off to Diego to go over the industry and competitive positioning.
We use 45 forces to understand the European telecom industry. We found a high intensity of competition as the new rules and regulations are forcing companies to sell their extra space on their network at a retail minus price, allowing small and medium companies to compete more aggressively. All of these seeks to increase competition and drive down price. Another factor driving competition is low switching costs. This makes the bargaining power of customers moderate as it allows customers to switch carriers anytime there is a better value proposition being offered in the market. An industry trend is customer convergence as customers seek to obtain all their services through one provider, while broadband and mobile keep driving industry growth. Convergence allows customers to access all their services through one provider, while accessing all services and content they want at a lower price with an enhanced user experience. We conducted product research in order to compare the product and pricing of Liberty to its competitors' offering. We found that Liberty offers some of the fastest speeds with competitive prices relative to their competitors in each of the markets where they operate, for both their low and high-end products. This advantage will help to drive RGU growing into the future. Another advantage is their Liberty Go comprehensive long-term growth strategy launched in 2015. Its goal is to generate both top and bottom line growth based upon its 4 key pillars: new builds with a focus on fiber, B2B growth, B2C product development, and increasing operating efficiencies to maintain a flat operating expenditure. In Q3 of 2017, Liberty connected 377,000 377,000 homes through Project Lighting and 311,000 in Central and Eastern Europe. This growth will allow them to increase their market penetration and coverage in these fast-growing economies like Poland, UPC's second largest revenue stream, despite having only 21% coverage. We would like to highlight their corporate leadership, especially Dr. Malone's experience in the telecom industry, as well as his ability to create and maximize shareholder value. A unique characteristic of Dr. Malone is his reputation and trust he has built among equity and debt holders. On the other side, Mike Fries, CEO of Liberty Global since 2005, has been a key component of this company. He's been able to grow businesses through strategic investment and acquisitions, build a solid and robust leadership team, and deliver great financial results. Now I'd like to hand it off to Skylar, who will cover investment drivers and valuation.
One of Liberty's key investment drivers is their strong market share. In each of their markets are typically first or second in both broadband and video subscribers. Another key investment driver is their share repurchase plan. In 2017, Liberty repurchased over 75 million shares and plans to spend another $2 billion in share repurchases in 2018. This shows their commitment to maximizing shareholder value and is accounted for in our valuation. Taking a look at Liberty's financial position, they have industry-leading EBIT margins, with the industry in the gray line on the bottom left there, or right there, as well as consistent operating and EBIT margins. Although they have a high level of debt, they manage it well. Another key point here is that they match subsidiary debt with local currencies. Due to the consistency of their margins, we were able to keep them stable in our projections. For our valuation, we did a sum of the parts with an adjustment on the discount to the C-class shares due to the lack of voting rights. We used comparable multiples on each of the operating subsidiaries and a discounted cash flow analysis for the joint venture to get our target price of $41.84 on LBTYA. We used an OLS regression to discover that enterprise value to EBITDA was not only industry standard, it was also the only statistically significant pricing multiple. We then looked at competitors in each geographic region, adjusted for competitive advantage to get at our estimated multiple. For VodafoneZiggo, we used a 5-year discounted cash flow analysis to account for the value of future cash flows provided by the investment. We calculated each of the parents' WACC and then adjusted it 50%. To calculate WACC, we first calculated the cost of equity using the Fama-French 3-factor model over a 10-year time period. We then used an 8 times exit EBITDA multiple to get to our terminal value, and then adjusted for Liberty's 50% ownership in the investment. For our price target, we made a share class adjustment due to the C-class is lack of voting rights, and looked at a 5-year time period to realize that A and B traded a 1.24% premium. After that adjustment, we got to our final target price. Now I'll hand it off to Anthony to discuss Monte Carlo and risks.
For our sensitivity analysis, we used a 20,000 simulation Monte Carlo that accounted for both growth and an average daily drift factor of 1.84%. This resulted in 60.1% of the overall results, resulting in a buy scenario. We then took a look at risk segments from market, operations, and economics. The largest of these being the RGU and ARPU growth rates. RGUs are represented by the bar, and ARPU is the line graph there. This was a key risk to us because we drove each of the subsidiaries' revenues by these numbers, and an impact of these could have a ripple effect through each of our pro formas. We expect strong RGU growth and around level ARPU for going forward into the future. Strategic M&A and investments by Liberty Global are also a key factor to growing both content and network base. If one of these were to underperform, they would suffer limited growth in that segment. Since Liberty operates in so many different countries and currencies, they're exposed to foreign exchange risk as well. They typically hedge this using currency swaps, and we're able to find their forward-looking exchange rate from each of the swaps held by each of their subsidiaries. Based on all of these factors, we reaffirm our buy recommendation for Liberty Global's price target of $41.84. Thank you. We would now like to open the floor to any questions you may have.
If you look at Liberty Global in Europe, how is the business different against another company in the United States, say Comcast? Not about stocks, just about the business, broader business, US or somewhere.
Typically in Europe, there's a lot faster speeds in the broadband industry, and it's a key competitive advantage to have faster speeds in the market, which is why we looked at the product differentiation and those heat charts, and found that they had better speeds, which is going to help them continue growth as demand for broadband data increases going into the future.
Also, it is a little bit more capital intensive as the European telecom industry is 5 years behind the American telecom industry. So they've been deploying more funds to grow their business in Europe.
Can you talk about the top 2 risks the company has and whether the company is poised to manage this risk successfully going forward?
Yeah, the RGU growth and the ARPU were the two, was the biggest, that top risk in the top right-hand side there. That growth rate we typically have managed, and Liberty Global has managed using those acquisitions of Base and CFACO Loops. They've increased those RGUs both inorganically through those and the ARPU through their stable price increases. This year, they're going to start doing only 1 price increase a year to reduce churn from each of those price increases in each of their different segments.
Additionally, customer convergence is a key driver of RGU growth. It has a slightly downward effect on ARPU overall because they have to offer a slight discount as they bundle packages together. But giving their customers all the services they want in one simple package is helping them to drive RGUs going forward, which is why they're making a big push into their mobile segment so they can offer all 4 of those products in quad play.
What % of their future revenue growth is coming from organic versus M&A?
We did not account for any future acquisitions in our model. So these projections were all based off of organic growth rates.
One question on the RGU count, because I think you're the first group to kind of show a historical trend. It looked like you had a massive drop off in 2017 for RGUs. Did you all ponder why that was?
Essentially, what that was the spin-off of Vodafone, or Ziggo into Vodafone. So it's no longer consolidated due to the 50% ownership of that subsidiary. So it's no longer included in the consolidated account.
And which did you weigh more in terms of your evaluation? Was it the DCF or some of the parts, or was it a combination of both?
So because we did just the sum of the parts, each of them had equal weights based on the value they brought to the entire price target.
So it's all proportional.
All proportional.
Based on what value each subsidiary brought in.
I think another one of the risks that you had on your chart was FX risk. So from the point of view of an equity holder, is it better to have a stronger dollar versus all the European currencies or a weaker dollar?
But I can go first and you can do it. So the big thing that we think we noticed is they hedged with a lot of the swaps. So it seemed to be more of a wash opportunity. It's either going to be capitalized in revenue, top line growth, or again in below operating income with the derivatives on comprehensive income. We might have another take the pen on that, but
and just to jump on, a weaker dollar would be better because we're converting back from European currencies. So the more value those have in the US dollar, the better.
If I own 2 stocks, Comcast versus Liberty Global, which one, the threat from Netflix, which company bucks more, Comcast or Liberty?
Comcast. So Mike Freeze talked about this a little bit in Citi's TMT meeting the other week. But essentially, the impact of OTT services in Europe is far less than in the US. It's not usually correlated with a cord cutting trend. Most households that are investing in an OTT content service are also using like Virgin Media's video services as well. So it's not as big of a threat in the European market as it would be to Comcast in the US.
I guess, on the M&A fronts, you mentioned that we have a long history of mergers and acquisitions, and you didn't bake any M&A upside into your forecast. I mean, just from your point of view, what do you think is the next M&A transaction, for this company?
Yeah, in terms of what's already on the books, it's Multimedia Polska. That's still a pending acquisition. But beyond that, acquisitions in the mobile segment are most likely. B2B would also be in there. But mobile would be most likely in order to enhance their quad play offerings. So we either see that happening in Switzerland if they get a good deal, or most likely happening in either Central and Eastern Europe or in the UK. Those would be kind of the key segments that would benefit the most from an increase in quad play.
What was your price target?
41.84.
42, okay, so my favorite question. So tomorrow you wake up,
Yeah.
the stock price is at $42.00. Does that become a sell, or what do you do?
I think we would have to look at the reason that it spiked overnight. Because of their M&A history, if they were to announce a major acquisition overnight and that increased the value, it could very well be a hold or a buy still. But if it spiked for no apparent reason, we would probably consider the idea that it would be a sell with little upside potential at that point.
What percent of the earnings expected is assumed to be coming from currency fluctuations, for currency gains?
Essentially, very little is coming from any of the currency gains they're really making is generally offset by the swaps that they have. So anything being brought back as revenue is generally offset by their derivatives that they hold. So it's kind of a wash at the end of the day. It's immaterial for the most part.
Along the same lines, if interest rates were to rise by 100 basis points, how would the company be impacted by that?
They typically use interest rate swaps to hedge out of floating rate interest payments. But in the ones that they do, it's typically Euribor rates based in a favorable exchange rate, either 25, 50, up to 100 basis points above Euribor. And with Euribor still being negative, their interest rate floor is 0%. So even 100 basis points now would bring up their overall interest expense. I believe it's Unity by only 25 basis points, 20 to 50 basis points in total with a 100 basis point increase in interest rates.
So let's say tomorrow Europe goes into a very severe recession. Should you be concerned about this company?
Yeah, we looked at how GDP growth affects their RGU count, and there is a correlation there. It's a little harder to look at due to some of the inorganic growth that they've experienced. But there is definitely a correlation. We want to look at that. However, telecom in a lot of ways is a commodity in terms of being a utility in that sense. So even though people might have some ARPU pullback, but overall they would probably see similar trends in terms of RGU as long as they can remain price competitive in the market.
And the fact that they have a lot of debt, that doesn't worry you?
No, they've done an excellent job managing it over the years. They did just fine through 2008. So we think they could do just fine through the next pullback in the market.
When do you see that happening?
If we knew that, we'd be making a lot more money. I mean, the business cycle is coming towards a top. The markets are heating up, but no one really knows when that'll be occurring. Could be end of the month, could be 2 years from now, 3 years from now. So it's really hard to say, but the market is definitely getting more expensive.
Are you concerned about John Malone's health?
I mean, not particularly. He's doing well as far as I know, and I think he'll keep kicking for a while. And even if he were to go into bad health, the company is under excellent management. Mike Fries has done an incredible job leading the company.
And to add on, I think he's done an amazing job building a pretty solid leadership team and a board of directors that are very experienced and come from all kinds of industries, from banking, from central banks, from like the best people from the industry are part of their leadership. So I think, and most of them have done a career, have been in the company for many years, and they have trained and they have gained some of that knowledge that John Malone has. So I don't see it as a concern moving forward. Thank you guys.
Thank you.
Thank you.
Thanks. So as you know, we're ahead of schedule. Our crew is going to be here any minute. It's a young woman. Her name is Ren, like the bird. If you already had. Ashley, there's still people out there? Are we on? It's on. You're. All right, everyone. Thank you very much. Pretty good food. Better than University Club last year. For those who, faculty and mentors and CFA Society members who've been here, some of you many times, this competition. I think all the students probably know a lot more about Liberty Global than they could have ever imagined. But I will tell you, based on I've spent my entire career as a buy-side analyst and portfolio manager. The people that work at the brokerage firms, even the junior analysts, you've just got an inkling of the amount of time they spend in terms of modeling, knowing companies, things like that. But it's also probably more work than you've done in any individual project, I would guess, at school. I want to thank our judges again, Rick Westerman and John Reed from Liberty Global, who've been very generous with their time both today. When they came into their office and they answered lots of questions, some of which were great, and some of which could have been, frankly, I thought could have been answered by reading the quarterly investor presentation. But that was early on, so you guys didn't know that yet. So I'll give you a mulligan there. Also, Vitaly and Maruti. Is Maruti still here? Oh, there's Maruti in the back there. Okay, good. And I also want to thank all of our graders. The graders are a little bit more anonymous because you don't see their names, and but I know these take a bit of time, and I have copies of the graders' comments that I will give to either your advisors or mentors tonight, and they give to the teams, and then I'll make copies of the score sheets for today and the next few days, and I will email those to the faculty advisor for each of the team. And of course, as I said before, the winning team is going on a trip to Boston for in mid-March, all expense paid trip. And so that should be a lot of fun. It's also interesting to see the difference between the team that had the highest ranking by the judge in the oral presentation was quite a bit lower on their written presentation, and team that did best on the written presentation was not number one, obviously, today. So there's some interesting big gaps, but it shows you've got to do a good job both doing your research and presenting to people, because if you can't make a persuasive case, even if you write a great report, your boss is not going to be that impressed. On the other hand, if you don't write a great report, you probably can't save yourself by doing a great job in your presentation. Which is kind of like doing this in school too, but I think of it from perspective as being in the workforce. So I'm going to tell you the 4th, 5th, and 6th place teams, give you those in alphabetical order, and then I will announce the top 3 in order. The 4th, 5th, and 6th in alphabetical, but not in the order they finish, is Metro, UNC, and Wyoming. And I would add, the scores are very close. It's not like, you know, between number 1 and number 2 or 3 or 4 or whatever. You've got gaps like that. Some of the point totals are just a couple of points apart. And then in 3rd place is the CU team. And in 2nd place is CSU, and in 1st place is Denver University. So if the DU team can come up here, we've got trophies for you. Never, oh. Too excited to take her trophy. I couldn't quite figure that out. Anyway, congratulations, and I'll talk to your advisor about the mechanics for continuing on. And our photographer is going to come up and do some shots here of the team together. I think you're probably already smiling. And I want to thank everybody for your participation. If you've got advisors and mentors, you got any suggestions on how we can improve the process for next year, let me know. And otherwise, we'll be talking again at the end of the summer for the next year's program. Thank you very much, everyone. And there's lots of food out there. Go get some dinner before the ride home. Thank you.
Good job, everybody.
And you carried us through this last 2 years. No. We did it, but you became a leader. Thank you. It's like always funny to watch the guys that beat up on us.
Yeah, so we have
Honestly, like, this is the golden girl. No, we all work really hard. One model, just for creative reason, and you lead us.
I will make copies.
I really want you guys to know.